So now let's talk about the so-called option Greeks. These Greek symbols, uh, delta, gamma, vega, theta, and we have rho and psi, right? These symbols describe the change in option premium when one input to the Black-Scholes formula changes while other inputs remain fixed. In other words, keep everything else equal. We just change one input in the Black-Scholes formula, and we want to know how much the option premium or some character of the option will change. The most famous and most important and something we already know is the so-called delta. Delta is the change in option price or the option premium when stock price increases by $1. And then a related Greek is so-called gamma. Gamma does not concern the option price change itself. It actually concerns the change in delta when the stock price increases by $1. The next one is so-called vega. It's the change in option premium when volatility increases by 1%. And we will say a little bit more about volatility later on, but basically, to get a correct estimation of the option price, you have a very good, very reliable prediction on volatility. It's a very important input, very important input in the Black-Scholes formula. Theta is the change in option price when time to mature decreases by 1 day. Notice that this is the nature for time in all formula or in all financial pricing situation. Time only moves forward, and as long as you have a set expiration date, the time left in certain financial contract always become shorter and shorter. So we're talking about the time is decreasing, okay? When we talk about theta. And rho. Rho is basically R in English, and it's the changing option price when interest rate increases by 1% or say 100 basis point. Anyway, this $1 change or 1% change or 1 day change, basically talking about unit, right? In 1 unit change in one input, how much the option price or the option characteristics like delta will change. In the following discussion, it's useful to recall that the call premium will be lower if the strike price is higher. Okay? Or say for lower strike price, the call premium will be higher. You are entitled to buy something with a very low price. The put premium will be higher if the strike price is higher. It's saying, put premium is the insurance. So if it protects you better with a high strike price, it's a good insurance. The cost is higher. It's useful to remind us that idea when we look at different examinations of the Greeks. Okay, first let's look at delta. It's basically the sensitivity of the option premium to a change in the stock price or the underlying price. In our textbook, we describe it as the share equivalent of the option. So one option equals how many shares, right? How many, or in other words, delta number of shares, that quantity change will be equivalent to one option change. With continuous compounding and calculus, we can show that delta in call option is ND1, the CDF at D1. delta in put option is minus n minus d1. So the kernel here is minus d1, and it's the minus of the cumulative density function. We know that the cumulative density function has a value between 0 and 1. So when you have minus something that is positive for sure, we know the delta for put is negative. Also, we know that, as we have seen earlier, n minus d1 is 1 minus nd1. And then for the put delta, we have minus n minus d1 is minus 1 minus nd1. So it's actually nd1 minus 1. So the put delta will basically move the call delta down by 1. And you can see it in this picture. These three lines, by and large, has the same shape. And then you move it down by 1, you have the put delta from the call delta. Okay, so what delta tells us is inform us how to create synthetic options. And as delta changes with the stock price, we need to adjust our synthetic position dynamically. Right? If we have an option to hedge, then this delta position on the underlying will adjust according to the new delta. Okay, we have a, to hedge a written option, we have delta times the underlying. In other words, delta shares of the underlying stock corresponding to the option shares. And then if we have a new delta when the underlying price change, we will need to adjust the shares that we are holding to hedge our written option. All right, let's look at this picture. We have, look at a call option. If the price is high, right, underlying price become higher and higher, delta gets close to 1. That means that when the call is deep in the money, delta is close to 1 for the calls. And for lower strike price, the call is way out of money, delta getting close to 0. The story is exactly the same for put, except for the different direction in the stock price. When the stock price is very high, right, the underlying price is very high, the puts are out of money, so the delta is very close to 0. And then when the stock price is very low, right, the puts are very deep in the money, then we have delta getting closer to -1. Right? So this what it says is basically if the stock price increased by $1, your loss in the put value will be close to $1. But if the stock price further decreased by $1, it's a -1 drop times the -1 delta, right? You basically gain $1 in your put value. So that's for different strike price. Now, how about time to maturity? Now look at this part when the call options are out of money, right? If the time to maturity or the expiration date is further and further from 3 months to 1 year to 3 years. If that is the case, delta become higher and higher. Basically, the out of the money option have a chance to become in the money option, and with further into expiration date, right? Further expiration date, the chance is higher. Now, when the call is in the money, right? When the call is in the money, if the expiration date is further away, there's a chance for the call to become out of money again, right? So here the delta for the call with longer further expiration date, it's lower. lower. When the call is in the money, further expiration date have lower delta. For the put, right? The put in the money when the underlying price is low, and the delta for the put is lower in absolute value. It's here is closer to zero. For the 3-year put delta, it's also closer to zero compared to the other two. It's just in absolute value, right? And then for put those in the money, right? Here when the underlying price is high in this region, the puts are out of the money. When the puts are out of the money, um, the delta for the put is also higher, like here in absolute value. Here in absolute value. Even though basically when the put is really out of money, the call is deep in the money, the delta value are quite close, quite close. Okay, we've just talked about this slide, so I will move to the next. Now, formally consider our hedged portfolio. Basically, we want the hedged portfolio contain NS shares of the underlying stock and the NC shares of the options, right? And C here's call options, okay? It is that minus B for call. It's a long position in the risk-free bond. In other words, if I have written calls, right, written the calls, and I hedge my written calls with certain long shares, because with written call I may have the obligation to deliver the underlying shares, so I need to hedge. And then by proper hedging, I will achieve this hedged portfolio have a risk-free return. Okay. The risk-free return only works if you give it time, right? Here, when we think about delta hedging itself, we sort of make sure the the clock stopped. So when the clock is stopped, what we have is basically, if you give 0 time, then this portfolio change value, consider the risk-free rate, right? Compounded at the risk-free rate for 0 time, the change in value will be 0. So that's saying basically, if what we want, if we want to this hedge, right, the change in the stock position value can cancel the change in the options position value. Make sure this change is 0. So we have basically the number of shares of stock plus the number of shares in the call times this derivative, the change in the option premium over the change in the stock price is 0. And this gives us, right, the ratio between the number of shares you need to have in order to hedge the number of calls you have written is negative delta. So if the dealer have written a call, right, the dealer need to set up the hedged portfolio by taking delta times the number of calls the dealer has written, that many shares of the underlying stock. Okay, that's how a dealer can hedge a written call. Not fully hedged, right? Just according to the delta. And later on we will see when delta change, this long position in the stock will change accordingly. So let's think about the idea of the hedged portfolio dynamics. changes in the underlying stock and stock price and time passing by. There are two factors here, right? So before I said that the clock is stopped, so you have the hedged value equal to 0 if you only let delta to work. But when you start to run the clock, let the time pass by, both these factors will change delta, and the hedged portfolio will grow at the risk-free rate. We will see that later on. And then it means what? Basically, two factors can change the delta, the underlying stock price and the time. And then once delta is changed, the number of shares you hold in the long position of the underlying will change. The changes in the long position, okay, these changes in the long position, maybe you need to buy more, maybe you can sell some, and with the proceeds you can invest in or lend out at risk-free rate, right? Invest in bond or lend out at a risk-free rate. And if you need to buy more, you can borrow the money. So this is the how the portfolio will evolve in terms of kind of actual money coming in or going out. It will all be at the risk-free rate. And because we are using a linear approximation, delta is a linear approximation. If we look back, right, the call premium has a convex shape against the underlying price. So it's not a straight line. It's not a straight line. It has some curvature in it. Then delta itself is actually all these tangents at a different underlying stock price. So it's linear approximation. Because it's linear approximation, there will be approximation error. And what we will see is that our hedged portfolio will grow at the risk-free rate, but with some approximation error. And that approximation error not only come from delta itself, but also the fact that the time is passing by. So let's think about the evolution of the hedged portfolio. The hedged portfolio itself can be viewed as a combination of the underlying, which is an asset. The option is a written part, which is a liability, and a bond position. This bond position sometimes can be asset. That means you bought a bond with maybe you have sold some shares from the long position. With the proceeds, you bought some bond. That's an asset. Or sometimes it's liability, means to hedge your call liability. If then you actually need to buy more shares and you borrow the money. Right? You issue bond at a risk-free rate, or you borrow at a risk-free rate, and that means the bond position is a liability. Either way, it's a bond position. This bond position can be assets or liability. It really depends on what happened. So at the beginning of the period, the underlying position is set up according to delta. Now, after the price of the underlying changes, the change in the underlying position value and the change in the option position value should be approximately cancel each other. Okay, this will give you the risk-free rate growth. The approximation comes from the linear approximation in delta, and if you think about a call, right, if the underlying price increase, the liability also increase. Right? The liability in the written call also increase. Your asset in the underlying long position also increase. These two increase should leave your portfolio value by and large not changed. But once the underlying price increased, then you will have a new delta. Now you need to adjust your hedging position, the long underlying position, right, according to the new delta value. This adjustment of the underlying position according to the new delta will result in change in the bond position, right? Money, sometimes more money is needed, or sometimes cash is generated from selling some of the underlying stock, and that all that money coming in, money going out, become a bond position. The post-adjustment value of the hedged portfolio stays the same, still just grow at a risk-free rate from last period. Okay, and the portfolio is ready for the next price move. You cannot go back to the beginning of the period. After the adjustment, right, the portfolio is hedged exactly according to the current delta. But when you go to the next period, maybe next minute or next 10 minutes or next day, this hedged portfolio will start to perform its hedging responsibility. But once that responsibility has been done, right, there will be a new delta, and we need to adjust the hedging according to the new delta. So if you think about continuous trading by the dealer who's trying to hedge a written call, right, it can really be second by second trading of the underlying, sometimes buying, sometimes shorting, or selling. Right? Okay, let's look at our Excel example. This is the dynamic delta hedging example. And we have 4 days, okay? A day from 120 to 119, 118, 117, right? So we start from 120, that's sort of the end of the day 120 situation, and then go to 119, and then adjust it, go to 118, go to 117. So it's kind of 3 adjustments. Okay, we will set up on day 120, right, before expiration date, set up the delta hedge accordingly. Now we have the underlying prices. The strike price is always 1,200. The underlying price, there's increase of $15, and the next day dropped by $17, and another drop by $6. So it's rise from 1210 to 1215, drop to 1198 to 1192. The dates, just a fraction of the year, risk-free rate always constant at 2.75%. The sigma is 20%. That's the standard deviation of the return. D1 and D2 calculated according to the formulas here, right? And we get the new D1 and D2. Again, remember in here we actually have the time, right? Square root of C4. So C4 here is the fraction of the year, right? The time is changing. So we know that delta is ND1. This ND1 ever change, right? Not only there is this, the D1 change not only come from the underlying price change, but also the time evolve forward. Okay, so this ND1, ND2, they're changing. And then with ND1 and ND2, we can use Black-Scholes formula to calculate the different call option price. And we assume that the dealer has sold 1,000 calls. Okay, this sold short 1,000 call, each call for a 1 share of the underlying. And delta is ND1. These are the delta value for different days. The number of shares need to be held by the dealer in order to hedge this 1,000 written call on the first date, right? 120 days before expiration is 583 shares, basically 1,000 times 0.5826. Okay, we round it up to one single share, so we need to hold 583 shares long in order to hedge our liability of 1,000 written call. Now, we sort of assume the dealer have the money or already have the shares. Anyway, that's the starting point, right? This is the portfolio value. It's this number of shares, the blue number, times the C1, which is the underlying price. Plus, well, the purple number here is actually negative, so that's the liability part, times the call premium, the brown number, 65.88. So that's the hedged portfolio value. Okay, this is before adjustment, and currently I need the long shares and the portfolio value to see the evolution of this dynamic delta hedged portfolio. Okay, let's go to the next day. 119 days before option expiration, we have new delta, right? We have a new price, and time has passed, so D1 change, and we have a new delta. Delta increased a little bit. Before we think about the delta adjustment, we want to see delta working in effect. We want to see the value evolution of the portfolio. So let's look at this. We have long 583 shares, and what we are talking about here is 583 times, again, D1, there's the new price, right? And then we shorted 1,000 shares, and there is this new value, right? Increase the liability per call option value, right? So we have increase in asset in the first term, and then increase in liability in the second term. And here, right, this is just compounding. D5 is the risk-free rate. D5 is the risk-free rate. C22, 22 here is that bound position in this cell, the blue cell. The green cell. So, because we sort of have no investment bond or lending or borrowing at a risk-free rate to start with, that part is zero, but it will not be zero once we have done the delta adjustment. This is the before adjustment realized hedged value of the portfolio. So from 639,550 to 639,795. And then if this 639,550 evolve at the risk-free rate, this 2.75%, it should be, right, C5 against, this is the risk-free rate, C5. It should be about 639,598. A little bit of increase from, this interest rate is not really high, especially when you count it for 1 day. It's only $48 increase, right? Here we actually have a bigger increase. It seems that what happened is the value of the underlying, the long position value grow a lot, a little bit higher than the increase in the liability. Right? Yeah. Anyway, again, this approximation error for all the delta, we have 0.5826, okay, is $197, so close to $200, and you can see, right, for the rest of the approximation error, it's all getting closer to $200. But the point here is that um, it does not simply reflect a change in the underlying price. It also reflects a change, or say the progress in time. Okay, but this approximation error is only 3 basis points for the portfolio, so it's very small. We can basically see our portfolio is growing around the risk-free rate. Right? It's, you know, $200 still a big number for most people, but for this portfolio, the error is quite small. But then we see our hedging need has changed, right? We have a new delta, 0.596, higher than 0.582, right? So we actually need to buy 14 shares more. And now we introduce the cash flow to adjust, right? Provide the cash to buy more shares. And then we assume that this one is coming from borrowing. So it's the blue cell, right? How many shares you need to buy times the green cell, the current share price. And we're talking about the bond position itself. So we, the first part is the adjustment. The second part is actually carry over from C22, right? The previous balance. It kind of based on the previous balance, the new cash flow needed. And that means we need to borrow another $17,000, $17,010. And after that, if you think about the whole portfolio value, because we have bought more shares with more liability, and basically the more shares financed by that liability, the whole portfolio value do not change. It's simply because the incremental change in the asset is compensated by incremental change in the liability. It does not change from before adjustment. Okay, before and after adjustment, it's no change in value. Okay, now look at basically the next 2 days. We do the same business, except the price now is declining, and then we have a lower delta. So we have 597 shares, right, before adjustment, and it's the same formula. To say we have this many shares, and this is the first term, right, and then we have this liability in term of written options, the call option price, right, and 1,000 the purple cell, 1,000 written options, and then minus the bond position we have accumulated that evolve at the risk-free rate. E5 is the orange risk-free rate, right? D22 we know that here the green cell is the bond position. That's our liability. So asset, the first term is asset, the second term is liability. We know that we written the call, and the bond position itself is a liability. Let's just assume that if it's positive number in the 22 row, right, it's liability. If it's negative, then it's asset, but then minus a negative term will become the asset, the positive term, minus positive. Okay, then if from the previous day, right, we think about the previous day post-adjustment portfolio value, right, grow at D5, the risk-free rate, from the previous day risk-free rate. that should be the hedged portfolio value, but there's the approximation error. Still, the 188 is not a small dollar amount, but it's a very tiny portion of the portfolio, only 3 basis points error. And now we need to adjust the hedged portfolio according to the new delta. We only need 548 shares. We need to sell, right? Blue minus the green. Here, 597, or the adjacent cell, 597. So we need to sell 49 shares. With 49 shares, this is negative 49 times E1, the new price, right? We have sold the shares, and the previous loan balance grow at a risk-free rate. Again, E5 here. Right? After adjustment, cannot by the end of the day, interest should accrue to the loan balance. That's your total loan balance. This is the total loan balance. It's an asset now. And what it's saying is basically the proceeds from the selling of the share not only pay back the money borrowed on the previous day, but also have a balance, right? 41,691. Again, this is saying what? I reduced the asset, and also I reduced my liability. Right? The amount that you can reduce is only 17,010, right? Only $17,010. That's what you can reduce. The rest you have to keep in the portfolio. And now, again, the post-adjustment portfolio value is the same from the beginning because the asset, I paid back $17,000 something, and then the rest still remain in the portfolio as cash, or say as a lending at the risk-free rate. Now, the next day, the price dropped for another 7 points, and then we have a new ND1. The delta keeps declining. The call value also declined. So the liability is decreasing, and so is the asset value, the delta times the underlying, right? Now, according to the delta, let me see, from yesterday, right? We still have 548 shares of the underlying. That's the number of shares we have in the long underlying position. And the blue cell and green cell is the underlying asset in long position. Purple here is the written call. Written call is the liability times the call value, which is brown. Purple times brown. And for the last part, still kind of minus the bound position that come from yesterday. And that bound position come from the 22nd line, the green line here. This portion should be the asset, right? We have the proceeds from selling the long underlying positions, right? So the 49 shares that proceeds become asset. So it's actually, see, here is a negative number, and then positive, negative become positive. So this is now an asset. Okay. And that's the realized value of the hedged portfolio today. Basically, after the price movement and time, the time has changed, right? Moved 1 day forward. If this balance yesterday grow at 3%, which is the projected value. 3% is the 2% and 75 basis points, right? That grow by 1 day. We have 639, about 700. What we actually have is 609,870. Again, the difference is $167. Still 3 basis point actually kind of higher than the projected value. From yesterday to the last day, right? It's basically the same story. So we always look at the portfolio value that we do have, and that is on this 16th row. And then on the 17th row, it's the previous day balance in the total portfolio, right? Asset minus liability grow at 2.75%. So the point is basically this is a risk-free hedged portfolio, right? Risk-free portfolio is fully hedged, grow at the risk-free rate. And then obviously the delta has changed to 5.53. So we basically need to only have 530 shares for the 1,000 shares of return call. That means, well, we need to sell another 18 shares. 530 minus 548, yes, right? 530 minus 548. This actually bring more, right? This 18 shares, the blue cell times the price up here, the green cell here. This is more proceeds. This is more proceeds plus yesterday's proceeds. Okay, this is actual bond position, and this one again it's an asset. Actually, it's a investment, right? Long bond position, long risk-free asset. And what have happened is basically if you have this balance sheet in your mind, right? This is purely change some of the long asset from the stock position into a long bond position, long treasury bills position. And that's just asset category movement. And what will follow is that still the treasury bill themselves still evolve at the risk-free rate. And then what's left in the asset is your long stocks versus the liability part will be the return call, right? So these two items, right? One asset, one liabilities, their movement in the next move still will cancel each other's move, make the total portfolio growth basically at the risk-free rate. That's the purpose of this example. Okay, we can go back to our slides here. It's another example, another numerical example. We sort of talk about different point. In the previous Excel model, we have the whole process. In this example, we talk about a different point in the process of dynamic delta hedging. So if we look at right, what is the underlying price on November 18th, 125.75. Strike price is 125, so it's very close to at money. And then there's 60 days to maturity, risk-free rate 4%. This call premium is $10.89. The dealer has written 500 calls. The delta is 0.5649. So that's the current delta on the 18th. Now, question A. Say at the end of November 19th, suppose it's post-adjustment. Show the hedging in working for $1 increase in the stock price. Okay, it's basically that scenarios can happen on the next day, November 20th. So because it's post adjustment, we actually look at the new delta. It's not this 0.5649. It's the 0.6564. So 6564 times 500, we basically get a long position in the underlying of 328 shares. Now, what's gonna happen to our hedged portfolio, right? If there's $1 increase in the stock price, we will have an increase in the asset, right? A long position increase, $328. I have 328 shares. Each share increased by $1, so my asset side increased by $328. The call option change will be, we can approximate, okay? We'll talk more about this approximation later on. What we are doing here is basically saying, well, delta by definition is how the call premium will change when you have $1 increase in the underlying stock price. So when there's $1 increase in the underlying stock price, the call premium change should be delta times the number of calls we have written. And this is exactly delta times the minus 500, and that's our liability. So this is negative 328.2. So basically, right after $1 price movement, remember this is in the same day. So let's say the risk-free rate hasn't really kicked in yet, right? This is in the same day, so there's only a small approximation error of 20 cents for $328 movements on both sides, right? The asset increased, and so is the liability. This is kind of additional liability increase. They, by and large, right, both increase by the same amount. So it's the net position still evolve at a risk-free rate, or the net position change is basically close to zero here. The approximation error is 20 cents. Okay, now let's say on November 20th, the underlying is $122.75. The call become $9.09. Still, there's this 500 written calls. It's basically 5 contracts, right? 5 contracts, 5 written call contracts. Each contract has covers 100 shares. Delta become 0.5176, and this is before the adjustment. We just talk about the number of shares, right? According to the November 19th new delta, right? So we have this delta determines that we still have 328 shares. Now let's say the bound position is negative 6,072. That's the bound position value. The total portfolio value is 29,645. Okay, so this is what we have right now. The question B asks us to show the breakdown of the portfolio on November 20th. So what we have? We have 328 times 122 and 75. So this is the asset. Liability, total liability from the written call is minus 500 times 9.09. Okay. Again, basically, what we are saying here is after basically on November the 20th, right? What we have is new underlying price resulting in new call option value, right? And this bond is still here. This bond is still here. So before we change our portfolio composition to reflect the new delta, right, we have this total kind of equity in this hedged portfolio as $29,645. Okay. Again, the long position in the stock is 40,262, and our liability in the call is 4,545. And we also have this borrowed money. This is borrowed money. This is straightforward negative sign, right? 6,072. Okay. So basically, what we are saying here is that we have this liability in the call, and we have borrowed $6,000 something to finance the long position, right? There's basically initially in the setup, I should have put in my own money to support this long underlying position, and my own money still have $29,645 left as equity in this whole portfolio. Okay. Question C is given what we have in the previous slide, right? Show the delta hedging adjustment for November the 20th. So the new delta is 0.5176, and that means roughly we need to only have 256 shares in the underlying, right? Before we have 328 shares. So what do we need to do? We basically need to reduce the long underlying position, means we need to sell 69 shares. Again, when you're selling the shares, you basically change asset from shares into cash or T-bill. Okay, so that bring in roughly $8,470. Okay, 69 times the current share price. And this new money come in can repay the debt, right? We borrowed $6,072. Now we have $8,470. Basically, after pay back the 6,000 something debt, we have $2,398 left in the portfolio on the asset side, and that's kind of in the T-bill. So portfolio at the end of November 20th is, well, what do we have? You have the long underlying position 259 times 122.75, which is the share price. You got $31,792 in the long underlying stock. The written cost still is this number, $4,545. Okay, and the whole portfolio value is what? If we have this long position in the underlying stock and then this liability, but now on the asset side, right, you still have $2,398. That's in credit bills. right? The whole portfolio value is still 29,645. Okay, same portfolio value. In other words, I should say the portfolio value we are talking about here is sort of the equity value in this whole balance sheet. Okay, there's assets, the long underlying. Now the bond position is also an asset. The liability is the return call. Now, on November 21st, notice that over time, we actually have the time itself changing. That's give you the delta change, right? So, question D asks us to calculate the portfolio value, or say the equity value in this whole asset liability balance sheet, right? Before adjustment on November 21st, and compare it with a benchmark based on November 20th value. We know that that benchmark should be what? Should be this November 20th portfolio value grow at the risk-free rate 4%. So that's 29,645 grow at a continuously compounding rate of 4% for a day. So 29,648. It's not big change. Okay. And you can see that the change here is actually very small, even for $29,000. So yes, we should continuously compounding grow at 4% on these $2,398, but it won't make big change. So it's roughly still that number. Now let's look at what we have on the long underlying side. We do have before the adjustment, right? We haven't adjusted it for the new data yet. So we still have what we had left from yesterday, 259 shares. 259 shares times 120 and 50 cents. That's the current share price. We got $31,210. That's the long underlying asset position. On the written call, the call has decreased in value again, so we actually have a reduction in the liability. The liability side is smaller. It's only $3,940. Before we have $4,545, right? Now it's $3,940. The bond position, as I have said, this is just approximately grown very little. So you add things up, you got $29,668. That's only $20 difference from the projected value. Again, you always see a rather kind of big approximation error in terms of dollar amount, but if you look at the total portfolio percentage, that is actually a very small approximation error. So by and large, we have achieved risk-free growth, and the portfolio is completely hedged. Now, in this kind of calculation, we have seen the delta, right? The amount of delta change determine how you need to buy or sell the underlying stock. So the change in delta matters a lot for the trading, for the dealer, right? So we have this concept of gamma. It's basically the approximation error of delta. We know delta has an approximation error, and I want to say it again, the previous approximation errors that we have seen, most of the cases, what we have is both the delta change come from both the underlying price change and the time passed. Okay, it's not a simple price change. So what we are going to talk about here will be about the simple price change, and the implication and the previous numerical example may not match. Okay, sometimes it may match, sometimes it may not, just because time there's also a time factor, which is the what do we call it? The Greek, right? Theta, which is the theta. Okay. Let's look at the approximation error of delta. So basically, what I have is start from a underlying of 68.50 cents price. Okay, this is the underlying price, and I'm not changing the dates, not changing the expiration time. I only examine the price going up $1 or down $1. The second column is down $1. The third column is up $1. So I only examine that. I have my Black-Scholes, and all these put call premium are calculated. You can see the formula here, right? All these are calculated by Black-Scholes. And now what I want to do is, well, I do have delta here, right? For the call, I have ND1, which is 0.66. For the put, it is negative 1 minus ND1. Okay, that's the put delta. So it's exactly very close to 34%. Okay, as we have said, if there's $1 change in the underlying price, then the call premium you use delta to approximate will be delta times what? Delta times the call, right? Which is the amount change in the underlying price. So the formula here is basically where we have started, and then delta is the green number in the green cell, times what have changed, the difference between the two prices. Okay, so this is the delta approximated call premium, $7.25. In Black-Scholes is $7.26 something. All right, for the put, it's still the same story. You start from the Black-Scholes put value, right, plus delta times the change in the underlying price. And the delta approximated put premium is $3.97. The Black-Scholes put premium is $3.98. So for both put and call, there is basically 1.3 cents approximation error. If the underlying going up by $1 from 68.50 to 69.50, and again, we still can do this approximation, same as before. It's the delta times the change in the underlying price. Right? This is increased by $1. So basically, $7.91 plus 66 cents. You got $8.57. Here for the put, it will be $3.63 minus 34 cents. You got $3.29. Here, and compare the approximated call premium with the actual, or say Black-Scholes call premium. The approximation error is also kind of 1 cent more, right? Slightly higher than 1 cent, 1.2 cents more than the Black-Scholes value. So this comes from the fact there is this convexity. Let me get to the if we have look at this whole picture bigger. right? This is the call premium line, the blue line. It has this convexity in the underlying price. Okay, so when I have a tangent on this what the premium line, right? This curve, that's my delta, right? So let's see. The theoretical price will always be higher than my approximation price. Right? So 726 over 725 for the put, 398 over 397, and for the call, when the price goes up, Black-Scholes give you 858, and Delta give you 857. For put, Black-Scholes give you 3.30, right? Delta give you 3.29, and all this come from the fact that this call premium has this convex curvature, and when you have a tangent line, right, you move up and down along the tangent line that's moving with delta. The whole tangent line fall below, because it's convex, right, fall below this premium curve. That's why the delta estimation, right, delta adjustment, delta estimation or approximated value always fall below the theoretical value of Black-Scholes. Okay, and the size of the approximation error, this error is positively related to the change in delta. So if delta is bigger, right, higher, then the approximation error will be higher. And if you adjust the portfolio according to delta itself, right, what we are saying is basically you are not doing enough adjustment, or sometimes you may do more than necessary adjustment. Really come from the approximation error, and that kind of overdoing or underdoing, right? Over adjustment or under adjustment can give us problem. And to think about how big is the approximation error, there's the concept of gamma. So what is gamma? Gamma is the change in delta, right, compared to, or say divided by, the change in the stock price. So for $1 stock price change, how much delta will change? And it's basically how much the slope of that tangent will change. And that idea gives us how much the approximation error will be. So delta is the first order effect from the underlying price to option premium, and the gamma is the second order effect. Call gamma equals put gamma because we have the put call parity. So it's basically delta take a derivative with respect to the underlying, and basically because going back, right, both put call depends on ND1, and there's two negative sign on the put delta, right? One inside ND1, the other outside ND1. And then if you differentiate this one, this delta, right, ND1 are negative and negative D1, right? Differentiate those two things with respect to the underlying price. Again, you basically got the same number, which is gamma. Okay. So that's why call gamma equals put gamma. When gamma is large, delta changes rapidly. That means delta approximation error will be large. That makes the dynamic delta hedging fail. And let's look at why is that. Okay? And we have said delta is a linear approximation of a convex option premium curve. Let's think about written call as an example. When the underlying price going up, current delta underestimate call premium increase. So the underlying price going up, right? The call premium going up, but the approximation do not go up as much. It basically means we, on the asset side, the underlying, right, went up. The underlying on the asset side went up, and but the call premium increased even more. Right? The liability side actually increased faster than the long stock position, or say the written call loses money, right? You have more liability, and that growth in liability is faster than the growth in the long stock position, making money, right? This means basically this can become a unhedged net short, and your liability going up faster than the asset. So it's kind of it's a written call, so it's a short exposure. But when you have this short, right, the stock price is going up. What do you need to do in order to hedge? You need to purchase the stock at a higher price. Not only you're buying high, right? Yes, you buy high according to higher delta. But remember, delta itself is not enough, right? So you actually need to buy more. There's to achieve this complete hedge, you actually need to buy more of the underlying than what can be given by your delta when the underlying price going up. So the trader need to buy high if the approximation error is big, right? Kind of the price going up, they not only going to adjust for the new delta, but the original delta, the current delta is not enough to compensate the increase in liability, so they actually need to buy more to achieve complete hedge. Now, think about the underlying price going down. Right? The current delta overstates call premium drop because, again, you have this curve, right? When it's going down, the call premium curve kind of flat out, right? It's going up a little bit, not just straight down according to a straight line slope. So, what does that mean? It means the written call makes money. Right? The written call now, its liability start to decrease. The underlying become cheaper, call value decrease, the liability decrease. But that decreasing speed is slower than the long stock out position loses money. Right? You have a long stock position to hedge your liability, and now stock price going down, the liability is supposed to go down by the same amount, but actually, because of delta means the change is bigger. That delta, the change is bigger in this whole position. The whole position means, there's the long in the stock position lose money, right? Your asset decrease in value, your liability decrease in value, but it decreased less than the long underlying. So there's a gap, right? There's a gap. Supposedly, the the liability should, right, if delta is a good approximation, the liability should decline by the same amount as the stock position decline, right? But now, because delta is not such a good approximation, the call value didn't go down that much. So the liability declined a little, the asset declined more. This can become an unhedged net long position. What does this net long position means? It means, well, you have this long exposure, right? the total portfolio value decline as the underlying stock decline. That's a long exposure, right? It move together with the underlying stock, which is a long exposure. But the underlying stock price is declining, so is your total portfolio, the asset and liability together. Okay, so in that situation, it's, when the underlying price is going down, it's not a good thing to have a net long position. Same situation in the previous slides, right? As the underlying price going up, if you have unhedged net short, basically a short is losing money when the price is going up, right? It's not good to have a net short position when the price is going up. It's also not good to have a net long position when the underlying price is going down. So in this situation, right, basically the underlying is losing more money than the reduction in liability in the return call. So you actually need to get rid of the losing money long underlying position, right? You need to sell it fast. And what it means is quite damaging, because look at this approximation error result. When the price going up, the dealer need to buy more. When the price going down, the dealer need to sell more, okay, to make up the insufficient delta approximation. Buy high, sell low, not a good way to make money. In other words, when there is a large magnitude swing in the underlying price, the dealer may lose tremendous amount of money, because they are trying to perform delta hedging, but the delta just changed so fast, they cannot catch up, they cannot achieve risk-free portfolio hedge. Okay, they end up have the exposure, either net long exposure or net short exposure. In both cases, it's not good, because the price is moved in the wrong direction, so to speak, right? Make you lose money for that exposure. So when gamma is large, rapid market price movements can break down the dynamic delta hedging, cause big losses for the option dealers. All right, so when delta will be large, right? We need to know when the, not delta, gamma, when gamma will be large. And look at for different strike, right, from 20 to 60, and different expiration dates. The earliest expiration date is this 3 month. The cross line, the diamond line is 1 year. Diamond line 1 year. Triangle line is 3 year expiration date. So now what do we know, right? You have getting closer to the expiration, seems gamma can be big. Also around at the money, right, in the middle here. So gamma will be larger when the option is at the money and the option is closer to expiration. And this will be the two conditions for an option dealer who has written this option. They will be very careful if they want to perform delta hedge. dynamic delta hedging, it can be difficult because there's large value in gamma. In other words, delta hedge itself is insufficient and delta will change dramatically, make delta hedging very difficult. They may not be able to achieve risk-free portfolio after they have done the delta hedge. So remember, gamma is the same for call and put. So when options close to expiration, right, the delta of in the money option, right, moving quickly to 1, then out of the money options moving quickly to 0. So gamma will be high. Okay. Gamma will be high because the delta move fast. Okay, there's not much time left for the underlying price to move around. And what you're gonna get, what you have now, right? As you're very close to expiration, what you have now is very likely to be what you have at the expiration time. So once the underlying price move, is basically give you the delta, right? The delta will change a lot. Now, during the life of the option, right? Now we're thinking about the different underlying price level, right? For in the money options, delta is higher than a half, and it moves slowly to 1. Okay, so if the option is in the money, right, here or here, right, for the high price level is for call, low price level is for put. What we have is delta can be higher than 0.5, and it moves slowly to 1, right? It's because the option is in the money. It moves slowly to positive 1 or negative 1, but basically it maybe end up in the money. And for out of money options, right, delta is less than a half and moving slowly to 0. So for either out of money or in the money, right, on the high stock price level, it's in the money for call, out of money for put. Low stock price, in the money for put, out of money for call. On these two ends, right, gamma is low. Gamma is low because the change in delta will be slow, right? And delta will change a lot around at the money prices, just because it will become, from maybe very flat to very steep, or from very steep to very flat. Okay. Basically, the slope change a lot around the kink in the intrinsic value in this picture, and if they are in the money or out of the money, you can see it's by and large flat, right? It's very close to a straight line. That means the change in delta will be small, gamma has a low value. So gamma is low for deeply in the money or out of the money options, right? Again, the quick summary is that gamma is higher if the option is at the money, and gamma is higher if the option is closer to expiration. Obviously, if you compare several options out there and we ask you which one has the highest gamma, you pick the one that is around at the money and very close to expiration. The next Greek is so-called Vega. It's the option premium change due to 1% increase or 1% change in volatility. The volatility you put into the calculation of Black-Scholes. So let's say for a call, right, you have the change in the call premium and then the change in the standard deviation of the underlying stock return. It's you calculate it as 1% times 100 for that change. So 1% change, right, in volatility, how much call premium will change. And if we just add 1% to the original standard deviation, we will have a new call price, right? That new call price minus the old call price will give us the Vega. It has the same value and positive for both call and put. Okay, let's look at my Excel model here. Obviously, if we want to show mathematically they have the same value, we do a little bit calculus. But here, what we do, we simply add 2 percentage point to the standard deviation we are using in the Black-Scholes model, right? And then we have the two different prices for different, from 38% to 40% for different standard deviation. Then we can see the premium change. This premium change is the same amount for both call and put. They both increase the option premium, and they increase by the same amount. So Vega, when you calculate Vega, is still the same amount, right? The same amount. The only adjustment in Vega is that we adjust the percentage change into 1% change in the standard deviation. Now, the most important thing is that as the volatility of the underlying increases, the option will be more likely to expire in the money for both call and put. Okay, for both call and put, there's higher chance for the price move into the in the money region. And that's why volatility actually kind of good for options. Right? Options, if you think about them, options can be viewed as insurance. The put option obviously ensure the long position, but the call option sort of ensure you to have a chance to buy this asset at a low price. Right? The Vega value, right? Vega is higher. In other words, the volatility is more valuable to the option, right? If the option is around at the money. So if the underlying price is around the strike price, then Vega is higher. Or if the option is further from expiration. Obviously, if there's longer time for the underlying to move around, right, volatility will have higher impact on the option premium. Because volatility is very important, if you have a wrong estimation of the volatility sigma value, right, that will result in erroneous option premium value estimated using the Black-Scholes. So it's very important to have correct volatility estimation. And the good news is actually that we know we can predict the volatility fairly accurately. Okay, so this is the picture for Vega, right? We have different underlying prices. So around at the money, we see Vega is higher and higher. And these straight lines from 3 months, 1 year is the diamond line. Triangle line is the 3-year expiration date. So as the expiration date going further and further away from the current time, vega is higher, and when the underlying price is around at the money, vega is higher. Next Greek, theta. Theta is basically time, and the most important concept is so-called time value decay. It's how much option premium decline as time to expiration decreases. Right? As time passes by, the option premium actually become lower and lower. It's basically because there's less time left for the underlying price move further deep into the money, right? Deeper in the money. The time value decay concept is basically the time value of an option declines as it gets closer to expiration. It means less time left for the underlying to move into the direction that give the option higher value. Theta is the rate of time value decay. Theta is usually negative, okay? It's the premium with respect to t. If t is the lower case, right? T is the lowercase t is basically as the lowercase t become bigger and bigger, the premium become lower and lower because it's getting closer to capital T, right? The expiration date. There's exceptions to the negative time decay, right? The time value decay. For deep in the money options, those options can be closer to a risk-free bond. Then it can earn time value of money. Right? In other words, it will have a positive time theta or positive time decay. So let's look at what do we have in the picture. And this is the call premium on the top. So as the time to expiration going lower and lower, right? That's how time pass. The call premium decrease. For all three different strikes, the lowest strike, right? Low strike call has higher premium. So the lowest strike is on the top, right? The highest strike, $50 strike option on the bottom. So this is simply the comparison of three different strike price, right? The cross line on top, diamond in the middle, triangle on the bottom. And then by and large, as time passes by, the call premium decrease. For the put option, when the strike is very high, this put here, right? When the time to expiration is getting closer, right? Because this high strike, the premium actually increase, okay? The premium actually increase because it may be deep in the money. So that's actually the positive time decay. Time decay is greatest for at the money short-term options. We look at the time decay. What we are looking at is the negative value. Okay, we look at which one give you kind of more negative value. This is the expiration. Okay, so the horizontal axis give us the stock price, and look at this one. We notice if the underlying right is at the money and the time to expiration is short, right? 3 months here. It has very negative theta. The time decay is greatest. This is for put on the bottom. Still add money. Short-term option. This is 3 months. 3 months. Put option, right? Add money around $40. That's the greatest theta. Right? The very negative theta give you largest time decay. However, when you look at this put, when the price is low, right? When the price is low, you actually have this positive theta. It's the positive time decay. When the time getting closer and closer to expiration, the option is deep in the money. It has this ability to earn risk-free rate, behave more or less like a bond. So there's the positive time decay. So, for theta, most basic thing is that we know there's time value decay, right? As time passes by, the premium value of the option decline. It means theta is usually negative. However, if the option is deep in the money, especially for put here, we can see you have positive time decay. Theta is positive. It's because it can earn time value of money just like a risk-free bond because the option is deep in the money. The option is deep in the money. So there's this one exception for positive time decay, but most of the time, the time decay is actually a decay, means theta is negative. Okay, rho. Rho in English, R is the risk-free rate in the Black-Scholes. So what it says is the change in option premium due to a change in the risk-free interest rate. Now, if the risk-free interest rate is higher, it will make the call premium higher because basically it decreases the present value of the strike price. When the call is in the money, you need to pay that strike price. But if the discount rate is high, the present value of that future payment is low. So the call option itself sort of give you a good deal. In that way, higher risk-free rate make the call premium higher. Obviously, here it's the opposite for the put premium, right? Higher interest rate, higher risk-free interest rate make the put premium lower because from the put option you are going to receive that strike price. The present value will be lower for that strike price if the risk-free interest rate is higher. And it's just for the call option, you actually deliver something have a very low present value. For the put option, you receive a very low present value. That's why the put premium is lower when the risk-free interest rate is higher. For European option, the premium is not very sensitive to the risk-free rate. In other words, rho is small. The absolute value of rho increases in time. Obviously, right? You need time for the compounding interest to work. So its significance, the impact of risk-free rate increase in time. And the absolute value of rho is higher if the option is more in the money, right? It's more in the money. It's more likely for you either to pay or receive this strike price. So the discounting on the strike price become more meaningful. And this is the rho for European call option for different underlying price. You can see, right, the short-term option, right? The expiration date is 3 months on the bottom, so rho, right? Increase in T for call. All right. This is the one last Greek, psi. Psi is the change in the option premium due to a change in the dividend yield. Psi for call is negative because during the life of the call, right, if you have a lot of dividend payout, it will make the terminal value of the stock lower. And that's basically more likely to put the call out of money. Obviously, if the dividend yield is higher, right, the future underlying price is lower, make the call premium lower. So psi for call is negative. Psi for put is positive because again it's decreased the underlying stock price. So high dividend yield increases the put premium. Psi increase, the absolute value of psi increases with time to expiration. So still, dividend yield, if you view it as a continuous compounding rate, more time make dividend yield more significant. And if the option is around in the money, right, it has an effect. If it's really deep in the money or deeply out of the money, then the dividend yield perhaps have very little influence. Psi basically has an opposite effect comparing with rho, really because they are on the different side, right, for call and put. So this is the value for European call for Psi. Again, for call, it make the call premium lower, so it's a negative number for the call. But for short-term option, the 3 months expiration date, Psi is just slightly negative, so it has a smaller value. In other words, if you give it more time, the dividend yield has a more significant impact on the option premium. So for the 3-year European call, right, the Psi is highly negative. Again, that's basically the absolute value of Psi increases with time to expiration, and if the option is around in the money. Okay, if it's around in the money, and this side is the call in the money, and Psi is more influential in call premium. All right, one last topic in this lecture is the implied volatility. We know when we are using the Black-Scholes formula, we need to estimate that volatility and put into the option pricing formula so that we can calculate the option premium. However, after all, option is traded in the marketplace, so you can actually observe the option prices. And we know, right, if the option is around at the money, right, near the money options, they can be quite sensitive to volatility. Look at this picture. Around at the money, so-called near the money, right? Volatility have a higher influence on the option value. Vega is higher. So going back to implied volatility. What we are seeing basically for near the money options, volatility is very important, and with historical volatility, right? You estimate this volatility based on historical returns. The expected future volatility can be different. Okay, you have an estimation, but the future volatility may be very different. And then based on the observed option prices, we can actually reverse engineer the implied volatility from the Black-Scholes model or Black-Scholes formula. Okay, we basically ask what kind of volatility value we need to put into the Black-Scholes formula so that we can produce the observed market option premiums. In Excel, we can actually perform this, okay, using the so-called GoSeek. So let's look at our Excel model. Basically, I have two sets, right, of Black-Scholes calculation. This is the same number before. The underlying is $68.50 and the $65 is the strike price. 110 days to expiration. This is just capital T is the expiration time. Risk-free rate 4%. Volatility, right? The historical volatility is 38%. We can calculate D1 and D2, ND1 and D2, the cumulative distribution function, then calculate the call premium according to historical volatility. But if you observe something different, say this is the observed value. Let's put the number back to 38%. Okay, let's put it back to 38%. In the market, you'll observe the option actually traded at $8.25, so $8.25. There's a 34 cents difference in the theoretical price and the observed price. And then we can ask for what kind of volatility value we can get this observed option price. So we go data in Excel, choose what if analysis, choose GoSeek. We set G20, this cell, to 0. We want 0 pricing error. And we change the cell of G8, which is the volatility we put into the Black-Scholes model. We click OK. It gives us a volatility value. Okay. This is not as good as before. Let's do it again. We are going to use the GoSeek here, change this difference, okay, to maybe a very small number, and by changing cell here. Now, because the function itself is highly nonlinear, Excel may have trouble to really find the good answer. Anyway, we change it to 9 here. That makes a big difference. 6, 8. How about 7, 5? Also still changing the number here. Okay, that makes actually 6, 7 or 6, 6. That works in the good direction. And I can do better than Excel. This is exactly what Excel is doing. Search a volatility number that give me a very small difference between the observed price, observed call premium, and the theoretical Black-Scholes call premium. And I guess I can do slightly better, just delete this two. That, give it 1. So actually 6.2 is good. Fine. Okay, now it's good. All right, so that's where the implied volatility come from. And this is what it looks like. And look at these shapes. They look like smile, right? This kind of U shape looks like a smile. In practice, right, or say in reality, the observed implied volatilities of in the money, at the money, and out of the money options are generally different. There can be a volatility smile refers to when volatility is symmetric, with volatility lowest for at the money option and high for in the money and out of money options. Okay. So there can be a smile, and then there can be a smirk, a lopsided smile, or frown. It can be an upside down smile. A difference in volatilities between in-the-money and out-of-money options is referred to as a volatility skew. So when you have this kind of smirk, right, this kind of smirk, you have a volatility skew. And there are some practical uses of implied volatility. If one have a true estimate of the volatility, in other words, you have a really good estimation of the volatility and you believe the market is wrong, right? Ultra low or ultra high implied volatility indicate option mispricing, or say arbitrage opportunities. So if you can estimate the volatilities better than other people and even better than the market, then it's possible to make arbitrage profits. For an asset with no observable price, if you can get the implied volatility, okay, if there's an option traded on this asset, even though this asset has no observable price, right? But that option has a premium, then there's an implied volatility from that option premium. And using that implied volatility, you can price another option on the same underlying asset. Okay. So that's another practical use of implied volatility. A third use is to quote option prices in terms of volatility rather than a dollar price. So remember, higher volatility means higher option premium. Right? So the implied volatility level, right? At what level of volatility you're calculating the option premium, basically tells people how much you value all different kind of options, right? It's basically describe the general price level of numerous options on the same underlying. One last use of the implied volatility is to validate the use of Black-Scholes. Basically, volatility skew indicates Black-Scholes is not a perfect model. There's something not quite right in the model. If Black-Scholes were literally true, sigma will be the same for options of O strike price and O expiration date, for all different expiration dates. Okay, so those are the practical uses of implied volatility, right? So the last one is basically saying, well, look at these option premiums, right? They have different implied volatilities or implied sigma value, So the Black-Scholes is not quite perfect. But still, Black-Scholes give us a way to price these options. That's actually a very important innovation in finance in the past century. Risk reversal is the difference between the implied volatilities of out-of-the-money calls and puts. Okay, both calls and puts are out of money, but it's on the two side, on two side. Why do we care about out of the money calls and puts? Because it's a way to formulate a collar. If you don't remember what is a collar, it's basically so-called range forward, and it give you this by and large negative exposure, right? A short exposure, and that can help you to protect your long position. Basically, you write a call and buy a put, both are out of the money, and give you a range that you can enjoy the upside of your underlying. So if for the out of money calls and puts, they have different implied volatility. In other words, there's a difference between the two implied sigma value, right? For the calls and puts that you're interested to use in order to formulate this collar, right? Then the difference in the implied volatility actually tells you the cost of this collar. Okay, it's a way to quote the price of a collar. Also, based on the implied volatility idea, there's an index called VIX created. It is a single so-called model-free volatility measure calculated using option prices for all available strike prices. Okay, so-called fear index. It tells us what the market expect, right? The underlying will move. Right? How large is the magnitude of the underlying movement? What does the market expect on that? It is a model-free measure, but it's actually based on this Wiener process assumption. So it's model-free. It's not assumption-free. So some people still say, VIX is not good enough. And that's what we need to know about implied volatility. Probably something to take away is that there's the so-called volatility smile and smirk and frown. And a general idea is that option prices can be quoted in terms of implied volatility, and sometimes it's a difference in the implied volatility. And based on the same idea, there's the fear index, VIX index. Right? What the market think the volatility will be for the underlying. One last thing to mention about the Greeks is that Greeks can be viewed as linear measures, just like beta for a portfolio or a duration for the bond portfolio. They can be added up. You can add up the Greeks in an option portfolio to get the portfolio Greek. And here we actually just need to use the number of options for a particular option position, right, times the Greek on that option. That's the weight here is simply the number of options. So it's a fairly simple calculation. Okay, that's the end of lecture 12.